The key question is really not whether the ECB will ease more, but does the market expect more than will be delivered? Claus Vistesen, Pantheon Macroeconomics. France's economic minister, Emmanuel Macron, has sent out a warning to the UK over a potential Brexit. What is your assessment of the economic impact that the uncertainty is likely to have in the run-up to this referendum?
Well, I think that from the Eurozone perch, there's not much that we can do in terms of we're takers of whatever the UK population decides. Obviously, Macron's comments today highlight that the European Union and the major Eurozone economies would very much like the UK to stay. That's a given. And they're also willing, I think, to play on the fears of leaving, which is one theme I think we will have to get used to for the next couple of weeks. In terms of the economic impact, I think we're already seeing it in some of the survey data that has rolled over a little bit, which is partly because of the financial market weakness in the past 2 months, but also I think because of the political uncertainty around Brexit. Obviously, these effects are going to be much more pronounced within the UK, within the English survey data, if you will, but I still think we're also going to see them in the Eurozone data. But as I said in the beginning, this is mainly a UK story to begin with. There's not much we can do in terms of affecting the outcome in the Eurozone, I think. And I actually think that it will remain mainly a UK story up until perhaps the very, very end of the vote. If we have a big lead in the poll for Brexit, then I think the market will turn its attention to some of the consequences of the Eurozone. But up until that point, I think it will remain a UK story.
Euro area retail sales edged down to 2% today, and deflationary pressures are steadily building on the ECB president, Mario Draghi, to act in this month's meeting. In December, you described the ECB's monetary policy as very, very loose. So what are you expecting this time around?
Oh, I'm expecting more easing. I think the data has been almost a perfect storm for the camp of leaning towards more easing. What I mean by that is that you've had inflation data surprising to the downside. You've had economic survey data surprising to the downside. You've had financial market volatility, and you add those three things together. I think the ECB almost surely will downgrade its inflation forecast next week, and as a result, I think you'll have more easing. The key question is really not whether they'll ease more. I think they will. The key question is whether the market now expects more than what they'll deliver. And we saw what happened in December when the ECB did ease, but when the market clearly expected more, and then the outcome in terms of financial markets was not what the ECB wanted. So that's really the key question. I mean, I looked at the surveys today, Reuters and Bloomberg, in terms of what markets are expecting, and I think the market is fairly balanced. I mean, my forecast, which is pretty much in line with the consensus, I think is a cut in the deposit rate to minus 0.4%, and an increase in asset purchases by 10 billion to a total of 70 billion. Then I also think they'll extend QE to Q4 2017. Now, that might sound very aggressive, but it's also very much, I think, in line with the consensus, given what we've seen in the data, in the sense that the Eurozone's back in deflation, and so I think that's what markets are looking for, and now it's really up to the ECB. I think the ECB is very well aware of where the consensus is, and whether the ECB wants to send a signal that it's looking through the recent decline in inflation because it believes that the economy is strong enough to generate inflation on its own further ahead. I think that would be a very reasonable argument for the ECB to make, but that's not the kind of argument I would expect from the ECB. The ECB has been very worried about second-round effects from low oil prices, and I think that story will be will continue to drive the ECB.
Lastly for today, what are some of the key Eurozone indicators that you'll be looking out for in the short term?
Well, look, I think we need to see a rebound in the economic survey data, which has been quite poor in the last couple of months. That would be one set of indicators that I'm looking for next month, especially the German IFO, where the expectations index crashed in February. Now, since then, financial markets have recovered, and the whole news flow has been a little bit less negative, and so I would expect a rebound. But I think that's key, because some of the survey data in the Eurozone have declined with the speed and to levels in the last couple of months, which, are starting to look a little bit like increased recession risk, which is important for me to emphasize. We see nothing to suggest that that's the case in sort of the slower moving data, industrial production, retail sales data, even GDP data, but that's the point. These data are move slowly, so they won't tell us if things are bad until way past the event. So that's why I think the survey data are important to look for in March.
Thank you, Claus. Be sure to check back with Dukascopy for more updates throughout the week. Goodbye for now.